What's up, Colorado? Chris Lopez here. And today we have a deal analysis on an 11-unit multifamily building that an investor purchased in Englewood, Colorado, which is a suburb of Denver. And what makes this deal so interesting in my mind is one is the financing that they use to take down this property. And the second is the creative value add business plan they put into here. It's not heavy construction, but I'll say it's heavier on creativity. And I've got my guest and also strategic partner, Travis Sperr with Renova Financial. Travis, how are you?
Hey, Chris, doing great today. Thanks again for having me here in the studio. And I look forward to breaking down the details on this deal and kind of how we got it done and what the investor is going to do with it.
Yeah, I'm excited to dive into it. And just to set the stage for everyone, you did the lending on this transaction.
Correct.
So we're going to walk through the deal analysis really from your perspective as the lender to get the deal done. So before we jump into the detail and the property details, paint us a picture about the investor profile, if you could.
Sure. Yeah. These investors, pretty sophisticated. They have a handful of multi-unit investments around town, and they have a unique strategy, which we'll really unpack a little later in using medium-term rentals. So we know that multifamily rents are up. We know that a lot of people are looking at short-term rentals right now, and there's some regulation around that. They found a niche in the medium term, which I think will do really well for them on this project, and the numbers kind of speak to it.
Yeah. And medium-term rental is 30 days or greater.
As
correct?
Defined, right?
Yeah,
As we sit here today.
Okay. Just to make sure I have it on there. All right. So they're very experienced. They got a very unique business model. Now, talk to us about the property, this 11-unit in Englewood.
Yeah, so 11-unit building in Englewood, close proximity to the hospitals in the area. Really clean building, probably 1960s build, brick, nice looking building. Really a turnkey type of asset at a relatively low cap rate in the market. But given the strategy, they'll be able to use the creativity, as you mentioned previously, not through a ton of construction value add, in order to really juice the returns on this and make it a great investment.
All right, so no major CapEx or construction. They have to pour in hundreds of thousands of dollars to remodel anything?
No, pretty much ready to go as is. They'll experience some cost in furniture and things like that, which we'll talk a little bit more in the medium term or midterm rental strategy. But literally could buy it and just collect rents today on this project.
Really?
Yeah.
Okay. What was the approximate cap rate they bought it at? Do you recall off the top of your head?
Yeah, as appraised, it was 4.5. So
okay.
Low probably for the age of the asset, not necessarily for the location, but still was able to pencil good enough, if you will, to get them into the project and into their strategy.
All right. And then what's the general bed, bath mix or the unit mix of this building?
Yeah, and these in this building, they were all 1-1s.
Okay, so all 1-1s and their business plan was to come in here, and I'm assuming they have long-term tenants already in place.
That's right, with rolling leases. And I guess the one piece, just so we don't get too far away from it, is one of the ways to add value is it's 11 units, but they actually own the same building make and model, if you will, across town. And there's a storage unit that provides some income, but not enough. They're going to convert that to a 12th unit. And so we didn't even have to use that in the numbers in order to get it financed, but it's a way that they'll be able to squeeze bigger return out of it when they get into their true strategy. So all the numbers will actually work without that, but just a kind of a bonus or some gravy on top of the deal.
Okay, awesome. Now let's actually walk through some of the numbers on the business plan here. So you said they bought around a 4.5% cap rate, 11 unit. What was the approximate purchase price?
It was just over $2 million or just over 2.1.
Okay, $2.1 million was about the purchase price. Now, I know they had a hard time getting financing on this property. And this is where you and Renova has, and it's a loan toolkit, came in to help get the deal to the finish line. So talk to us about their financing process, the roadblock they hit, and what you guys did to give a solution.
Sure. Yeah. And, from a financing perspective of having trouble, true at the loan to value that they wanted to be at, very financeable, bankable individuals, strong borrowers. But the challenge was getting to the loan to value that they wanted. And that was based on the income that was being produced. So to go along with the question here, the banks are generally going to look at market rents or as is rents, whichever's lower. And in this case, the property was under rented. And so they couldn't hit the debt service coverage ratio necessary to meet the bank's requirement, which I believe was a 1.25. In that case, the the leverage would have had to been reduced to 60 or 65%. So now you're talking about putting 30 to 35% down before executing your plan of rolling through the leases and maybe putting some money into it to get to the medium-term rentals. So it becomes pretty capital intensive at that point. And this group, sometimes they'll raise money from outside individuals to put the deal together. And then now you're looking at a bigger raise. You'd be the less leverage you have, the lower return to the investors, and just makes it a little more challenging to execute on the business plan. So where we came in was not looking, we still do look at the debt service coverage ratio, but the way we were able to get it done for them was to go to an interest-only loan. So when you're looking at an amortized loan, and keep in mind a bank might be a 15, 20, maybe 25-year AM, also cuts into the cash flow. Where we do offer a 30-year AM, that wasn't quite the best fit for them. So we went to a 5-year interest-only adjustable rate mortgage. So this gave them the ability to squeeze really as much cash flow as possible out of the deal while going through their creative strategy to juice the income and ultimately the NOI, and gives them then also the opportunity to hit that DSCR on our side, which got us to the 75% of cost or value for purchase. So they put the 25% down.
All right. I want to make sure I understand all this here, because this is great. So traditional bank, they were looking at like a 35%-ish down payment.
Correct.
To meet the bank requirements. And I think you said the bank actually referred the investor over to you for the more of the creative stuff, right?
Correct. Yeah. It was like, hey, we're having a little challenge here meeting what they're looking for. This might be a great fit for what you're doing. And in this case, when you have investors that are coming in and your goal on the deal is to increase your return so much by a different strategy, the interest rate almost doesn't matter. I mean, we're still market, but for our product, but it's more important to get the deal than it is maybe a point in rate or something like that.
Exactly. And then you were able to get do the loan structure. So they put a 25% down payment, which is, about the best leverage you'll get for buying a multifamily. And then a 5-year interest-only loan. So that means for the first 5 years, no principal, just interest, which on this size is probably $30,000, $50,000 a year in debt payment savings or something. I mean, that's a lot of money there that juices cash flow or probably funds a lot of the improvements on
Exactly.
there. So you got on there and you mentioned, I like this. Let's talk about this for a minute. Like that interest rates on these type of value add plays matter less. Can you talk to us a bit more about that and help people understand those numbers?
Sure. Interest rates are sensitive. They're especially sensitive right now. And but they're also relative, right? And so in a market where it's challenging to find deals, and maybe in a case like this, difficult to finance at the leverage you wanted to, let's say if it's a full point, or let's say it's 2 points difference in interest rate, what's the opportunity cost? And so when you're going to a more creative strategy where you're going to really pump the returns on the gross revenue and ultimately the NOI, the amount that you pay in interest is relative at that point, because now you're creating something that creates a lot more revenue, and you had the opportunity to get into the deal.
All right. So they got into the deal, 25% down payment, 30-year AM, or close to 30-year AM.
So 5-year interest only, and then that will roll into, at that point, a 25-year fully amortized. So depending on 5 years from now, they could decide, are they going to sell the property, or are they going to go refinance it depending on their rate environment, or do they stay where they're at and take the adjustment in rate, which would be somewhere around market. There's a handful of factors. So really when you're looking at doing interest only, you need to decide, is this the best fit for your business now, and how will we exit in X number of months or years if necessary?
All right. And we'll come back to that, what their exit strategy is on the loan. I want to come back to the actual, the business plan of the property. So they closed on this fairly recently. And the two main things that they're going to focus on is converting it to a medium-term rental and converting the storage unit to the 12th unit in the building.
Correct.
What's the timeline and tactical steps look like for that?
Yeah, so the leases were rolling, right? I mean, you've got 11 units, so let's just assume to keep it easy that you've got one coming up a month or whatever it might be. So relatively quickly, and this is actually good in this type of scenario too, because you've got some consistent cash flow coming in while you're building up this other strategy. The units were also under rented by about, in today's market rents, maybe $300 a month. So even though they bought it to 4.5 cap on existing, there was still some room to increase from there. So if you have leases that are rolling and by rolling, I mean they're going to come to term, say 1 a month. And then that's when you're going to give the tenant the notice that you're not going to renew. And then you're going to execute your plan. The cool thing is as you're buying that furniture and starting to market on Furnish Finder or whatever your means might be, you're bringing in your new strategy. But let's say at some point you're in month 6, you've turned over, this is your 6th one, 4 of them you put on medium term, and the next 2, you're just not getting them rented. You're just not, the market's not supporting that. Well, then you can still pivot and go to long-term rental, right? So the reason I say it's good to have the rolling leases is that you have the income continuing to come in, people in the building, generating a little bit of income while you're executing your new plan. So my guess would be probably over the next 8 to 12 months, they would get through turning the units, furnishing them as they see fit, marketing them appropriately on whatever that might be, Furnish Finder as mentioned, and then continuing to work through and increasing the return. So in year 2, it should look really good.
All right, so I'm going to dig in more into here. So medium-term rentals are often kind of geared towards people relocating, traveling nurses, and corporate housing.
Yep.
And sounds like here, since you're in Englewood, there's a bunch of hospitals nearby. I'm assuming they're targeting like the traveling nurses or people coming to visit family. They're kind of going after the hospital.
Yeah, based on unit size and cost to rent, that's exactly what's going to fit, is probably traveling nurses is going to be number 1.
Oh, that's right. It's one bedroom,
exactly.
1 bath, right? Yeah.
And then number 2 might be somebody that's in between locations. Maybe it's a temporary fit. Or, as I continue to hear how COVID changed everything, and somebody might just want to come to Colorado for 3 months, right? Or whatever it might be.
We got a ton of those people.
Exactly. So now in a good location. And the other thing about as the leases roll, then your new leases, which are typically 3-month stints for the nurses, are also going to be overlapped. So you don't have everything coming due at the same time.
So I love this. So plan A strategy is medium-term rental, maximize cash flow. Plan B, worst case scenario, is, hey, keep it as a long-term rental, bump up the rents to market rent. And doing some mental math, that would put it, I think, well above a 5 cap. Correct. If you raise those rents, which is a good deal. And cap rates higher than interest rate, interest-only loans, they're still in a very good position. So I'm really curious, I don't know if you know these numbers, because you said there's no heavy construction, no heavy CapEx. It sounds like more maybe some light cosmetic stuff and some furniture and furnishings in there. What's the general budget, do you know, for like turning this building into a medium-term rental, like kind of a per unit basis?
Yeah, so I don't have the exact number, but based on my experience, I guess, in construction and also in my short time in hosting short-term rentals, I think you would probably outfit one of these units for, probably with a TV and everything, I would say probably for around $4,000. And then let's say that you've got a little bit of money improvements, paint, maybe some flooring or cabinets, appliance, whatever it might be. So let's say you're at, let's say $6,000 a unit, just kind of rough math to turn around and get that different type of tenant on the shorter term.
Okay. So, that's a relatively low cost to do this. And then let's kind of compare rent time, because you're saying rents were under about $300. What would you say one long-term rental market rent over there is?
I'm guessing a little bit based on that location, but I think it's probably closer to $1,300 a month right now as we sit here today.
I would guess, 12 to 13 and change is what I've been seeing over there. And so for medium-term rental, what do they expect either from like a per unit or from like an overall building? Like what's the expected revenue on that?
So per unit on the medium term, I think you're going to be closer to, and maybe now even over about $2,000 a month. So that's about 1.5 times, right? Which would be pretty much the fit for medium term, where short term you might be 2 to 3 times. And I think what does it here is the location. Just because specifically going for the hospital piece is the traveling nurse piece is the number of hospitals in the direct vicinity, and also, a relatively good part of town, and even kind of affordable compared to some other places for somebody who needed a short-term stay or medium-term stay for the sake of definition.
All right. And through all this, I'm assuming they're going to convert that storage unit into the 12th unit in the first few months, whatever it is, to get that coming in. So let's just say it takes a year, maybe a year and a half to stabilize in season. Actually, let me take that back. So it takes a year to stabilize. What options do they have to then refinance or change their lending, with you, or what kind of options they have in general with those type of investments?
Yeah. And this is where it gets, I would say, a tad interesting. And I don't know if 1 year or 2 is enough. And the reason I kind of give the caveat is that when you're doing something that's different than what most people understand, being most people on a long-term 12-month or month-to-month lease, you're going to get a little hesitation on a refinance. So let's say, for the sake of conversation, in year 2, They've added that 12th unit. They have everything on medium term. They're creating way more cash flow than a like unit that's on a long-term lease. There's not enough data in the marketplace for medium-term rentals that a bank, I think, would say, oh, great, like we'll just use that last year because I don't think there's going to be any rental comps to support that. There's just not any areas in my mind. I know that you're starting to see more of it like North Aurora around Anschutz and probably in this area too where medium-term is picking up, but I don't think there would be enough data from a market standpoint to support the medium-term piece. The other piece on that creates some hesitancy on short-term or medium-term is that it's more of a business than the long-term rental piece. And from a lender standpoint, our absolute worst case scenario is always if we had to own the property. And if I had to own the property, I'm not going to operate a furnished short-term or medium-term type of business, right? You're going to want to know what is your value on long-term leases. And that's why they always go off of as is or market rents, whichever is less, so that you're in the most conservative and comfortable place possible. My guess is, Chris, that if you get into year 2, 3, or 4 with this plan, and you can show historically over this time frame, seasonally, how you've executed and that it's been consistent, then you'd have a much better chance to go for a bank loan based on the value that's been created through the NOI. And then your caveat then might be, do you have the ability to pull cash out or not based on that new NOI? Because if you might just get a better rate potentially or a better term, but I don't know how that would look for cash out. So the long way of answering the question is if they came back to me and say 3 years or whatever it was, and we can see this income, we're also going to go to an appraised type of view at it from an income approach and see where the comps are. And maybe there's more data at that point. Yeah, of course, you could go cash out up to say 75% of the new value. Is it on then a compressed cap rate? Who knows what happens in the market in that time frame? Yeah. But I think a lot of these moves are so much more toward just generating cash flow than they are maybe trying to add as much value as possible and then refinancing and taking it out.
Yeah, I mean, that very, I don't want to say simple business plan, but like the executive summary of the business plan, I should say, of just add the unit, get it to medium-term rental, and a 5-year IO period. That is a long time for them to go maximize cash flow, prove the business plan, and take their time to figure out, hey, what's the next best step for the property? Right. Refinance it, do nothing, sell it. Obviously, they have things on their portfolio, their life, the market, all that stuff. So lots of options on there. And Travis, as you're explaining all those options, this is, I think, always a good reminder that I'm often telling, my clients and just people I advise as they come through the podcast is don't get fixated on just what's the rates and terms, what's the fees on lending, because you just gave tons of what if this. It's the classic, hey, what's the answer to this? Well, it depends. There's this, or this, but that's reality of it. And that's where having like an experienced lender and also local investor, such in your case, is so valuable. And it goes such beyond of like, well, who's got this person's 1/8 a point cheaper, this person's 1 point cheaper on the funding fee. Who cares if they don't have the insight and that strategic advice that you're giving people? So that's a big reason why I like having you on the podcast and referring clients to you.
Yeah, thank you. And in this business, whether you're financing your primary with Joe or you're getting into a deal like this, having the relationships is more important than the price. Now, it can't be absorbent. We can't be 2 or 3 points off in rate or in fees. I mean, it needs to make sense, but when you're having these conversations and talking about, okay, how do we get through this? And, is this a trusted partner? And hey, help me on this next one. Can we get through this other deal? And that certainly does add a lot of value to the individual. And, you and I do this every day. So we really love talking about this. Just as a quick side, on this deal, we actually presented them the opportunity to go into a bridge instead of the term loan out of the gate. But what we determined was that there wasn't enough dollars needed, say, to convert that 12th unit and or to buy furniture, which a lender wouldn't fund as construction dollars, to go into a bridge, increase the value, maybe turn some leases, and then go for the refinance on the term loan, potentially even pull some cash out at that time. We just didn't see the upside being created enough in that short period of time. But let's say this building was dilapidated and it needed a bunch of work. Then, we would have presented the bridge, done the repairs, and then went for the refinance later.
But it sounds like you looked at the options and, hey, let's run through everything and see what makes the most sense. And that's what's great about having that like advisor type relationship.
Exactly.
All right, Travis, this has been great. I look forward to doing more deal analysis with you, more podcasts with you, because you do some very unique and creative stuff, which is just fun to learn about. So how can people get a hold of you to learn more about what you do and the products that Renovo Financial has?
Yeah, please. And I'd love the opportunity to just have a quick conversation with most and just say, hey, does it make sense for us to continue this conversation? I think we know pretty quickly after connecting whether the products that I have to offer are a good fit for somebody's business model. And if they're not, then at least we know of each other. Please feel free to reach out. I think we'll have contact info in the show notes. But, if you're driving down the road, it's Travis, Travis, at renovofinancial.com. I'd love the opportunity to connect with you.
Yeah. Travis, thanks a lot. And listeners, viewers out there, any questions, reach out to us in the comments, send an email, schedule a call with Travis. We love talking about this. And just as a constant reminder going forward, with our strategic partners, these are local experts here in their fields. They're investors as well. So they're a great person to pick their brain from and eventually do a deal and build a relationship with. So Travis, thanks a lot.
Cool. Thanks, Chris. Appreciate it.